Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at the US real estate market and my guest is Bob Jenkins, Global Head of Lipper Research at the London Stock Exchange Group. For the first time this year, US home builder confidence weakened this month as record-breaking mortgage rates and still high housing prices deterred prospective buyers, undermining a nascent recovery in the sector. So what then does Warren Buffett know that others don't? His Berkshire Hathaway fund recently took stakes in top home builders D.R. Horton, Lennar and MVR. Could it be the prospect of a new wave of construction activity? It is sorely needed as those mortgage rates also hold back many owners from selling their existing homes, meaning that stock levels for those are low. Housing is seen as about 12% less affordable over the previous year, according to one metric, but the performance of house builders themselves has been very promising. And with housing starts up around 10% in the same period, the sector does appear to want to build more. And despite those mortgage rates, demand still appears strong. Well, with me now is Bob Jenkins, Global Head of Lipper Research at the London Stock Exchange Group. Welcome, Bob. Let's first of all pretend we're Warren Buffett. What is his thinking in taking these stakes in those top house builders right now?
Yeah, he's always a step ahead, right? And of course, Warren Buffett and Berkshire Hathaway have a kind of a long-standing presence in the residential real estate space. Of course, they own a very large network of regional brokerage firms, so they have that going. They've had a lot of investments over the years in furniture companies and so forth, so they know a lot about what's going on in this space. So I think they're reading the tea leaves a little bit there. And of course, I think the overall home builder sector, as referred to, has done well so far this year, and it's a little bit of a speculative fervor, if you will, because you have this kind of immense logjam of demand for new homes from buyers, but you have the reluctance of existing home owners to put their houses back on the market with the great mortgage rates they got.
So, Bob, taking all that into account, what is that going to mean for the big US house builders? What are we going to see from them over the next 12 months?
I think what Warren's seeing as well here is that trend in terms of positive momentum into the home building stocks and home building companies is going to continue on, right? Because again, even if we finally find that rate range and it starts to get stable, you're still not going to see a rush of existing homeowners listing their homes. So that means the inventory of available homes for sale is going to focus right back in on the home builders. We've talked a little bit about some of the constraints they have, particularly in labor. So that means that they're not going to be able to kind of meet that pent-up demand, which will allow them to maintain premium pricing. So I think all the kind of forces that are at work here right now really align to be almost a perfect storm of good news for home builders over the next 12 to 15 months into these environments. And really, I think even beyond that.
Well, you touched on the disparity there between existing home sales and what's happening for new home sales, which are up pretty strongly over the last year. What more does that tell us about the market and the distortions that we're seeing? And what opportunities does that mean for investors?
I think one of the areas that we're looking at in terms of disruptions and opportunities are really in the trades. So one of the issues we're having in certain regions around the country is we're not having enough new tradespeople enter into the necessary trades to construct new homes, such as, you name it, roofers, electricians, plumbers, tilers, etc. If there's not enough new coming into that space, then the existing tradespeople and trades companies are going to be able to demand a price premium. And private equity shops are seeing that right now. So there's some opportunities there that smaller companies, regional companies that are in the trades are actually interesting right now.
And what about the DIY stores like Lowe's and Home Depot? They've been fairly resilient, haven't they?
I think they win either way, right? I think they win either if we stay in this kind of protracted logjam of demand, or we actually start to see it ease. Because in either event, right now you have existing homeowners who got these great low rates about 2 years ago, saving a significant amount on their monthly mortgage payments. Where are they going to put that? If they can't upgrade to a new home, they're upgrading their current home. So you have that kind of trend going into the DIY space. And if the logjam does start to ease a little bit, we know that anytime transactions pick up, DIY stores benefit. And there is a kind of a long standing correlation between the home price index, the Case-Shiller home price index, for instance, and DIY store sales growth. It's about 0.7 or so. So as long as we're seeing that index ticking up, which it has been mostly this year, presents opportunities in that space.
Treasury yields are spiking pretty badly at the moment. What if mortgage rates do go on going up? Can homeowners or home buyers adjust their expectations even further?
Again, it's going to find its home, and it may be 5.7, it may be in the 8s. But once it does, that new normal is likely going to be in place for some time to come. And the demand that's there and the lack, I think, of incentives for existing homeowners to list in a rate environment like that mean that I think we're going to have a nice kind of stable environment for home prices. I don't see them running through the roof. The math just doesn't work. But I can see them having enough demand to keep them in a stable and slightly ascending range over the next few years.
Okay, Bob, it's been fascinating to hear your thoughts today. Bob Jenkins, Global Head of Lipper Research at the London Stock Exchange Group, many thanks for being with us today. And that is your roundup of the US real estate market. I'm David Pollard, and this is Reuters.